Cool and Dre. Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
Welcome back to my YouTube channel, guys. Goofy Investing, where we talk about investing in the stock market. We're going to do a stock analysis on a requested company. So this company is a penny stock for all intents and purposes, ticker symbol INVZ, Invz Technologies. This trades on the NASDAQ for $2.31 with a market cap of $463.79 million. This is a foreign company, all right? They're headquartered in Israel, and they specialize in LiDAR equipment. For those that don't know, LiDAR are is an autonomous technology, more mainstream toward trying to mainstream autonomous vehicles. And this LiDAR technology consists of sensors on the vehicles that track nearby movements so that the vehicle and the system can maneuver the vehicle away from objects and so forth. All right. So in my experience, there's a good chunk of these smaller companies that are in this sector. My assessment of that actual sector and industry is I don't believe it's a winner take all industry, but I do believe that there may be 1 to 3 main players. All right. So we're going to be taking a look at one of these, and also going back to it in this industry. Something I've noticed is there are American companies and then there are foreign companies. We're going to go over one of these foreign companies, if you will, and we'll look at the financials, the business model. What do I think about how management is doing this and so forth? All right. So let's go straight to valuation. We'll do a sniff check on their cash. 79.38 million in cash, 35.26 million in debt. So net cash for all extensive purposes. Enterprise value is 419.6 million. For those that don't know what enterprise value is, it's essentially the market capitalization of the company, subtracting their cash and their debt, or adding their debt, or so forth. The ledger balance of the intrinsic value is the enterprise value. So whenever you buy a stock, you're buying their cash, or you're also buying their debt as well. All right. So if you buy a share of this company, your share will represent within that partial share or that partial ownership stake, the fraction of the debt versus cash on the ledger of that share will materialize as far as that share owning that piece of the balance sheet. All right. So we're not GAAP profitable, as you can see. On a price to sales metric, we're trading at forward sales of 7.68 times and a trailing sales of 11.06 times. I assess that the differential between the forward sales and the trailing sales with that gap should automatically be an indicator of higher projected growth. With that, we'll look at the projected growth right here. We're going to go to earnings estimates, and we're going to see, okay, by the end of this year, they're projected to do 148.70% revenue growth on their sales. Now, this may sound impressive, but lower scales launching from 0 to 100 million quarter to quarter, you're going to get these, it's easier to double sales when you're at these levels of scale on the initial launch. All right. And when you start getting more established as far as a foundation of a comp to go off of year over year, it gets harder and harder to achieve growth of sales on a financial metric and a forward moving financial metric, if you will. So consensus estimates, which 3 analysts cover this company, got them doing 90.82% for 2026, 74.39% in 2027, and a staggering jump in 2028 of 246.04%. But keep in mind that 246% is coming from one analyst. All right. So if I go to ratings, if we go to the Wall Street analyst ratings portion, Wall Street's got them at a strong buy. All right. And if we compare to Seeking Alpha ratings, still got them at a strong buy as well. Or I'm sorry, Seeking Alpha analysts got them at just a buy rating. So the street is more bullish than the actual retail crowd. That should say something. Let's look into some of the financial metrics. All right. After reviewing all their balance sheet, income statement, and cash flow, I'm liking what I see. All right, guys. From 2022, revenues have increased. Cost of revenues have also increased with them. However, if you look at SG&A from 2021, all right, SG&A has decreased, cut in half. R&D expenses have decreased about maybe 30% or so. So OpEx has declined. So sales are going up, operating expenses is going down. Everything is going in the right direction. Shares outstanding and net income. Let's look at that. All right. So I've noticed that they had some preferred shares here, which they closed out in 2021. That's what I like to see. It's a shareholder centric value creation that the strategy that the management is on board with. You can tell through the financials. All right. Net income loss is going down, which and going in the right direction. When I look at diluted EPS and the basic weighted average shares outstanding, there's no gap. So I like to see that. Your diluted weighted average shares are anything dilutive in nature, your convertibles, warrants, and so forth, and baked into the actual diluted weighted average shares, which calculates a year and over out that those shares are going to materialize into convert into actual shares, adding to the float. All right. I'm not seeing the progress made within the financials. Got the sales going up, OpEx going down, R&D going down, diluted shares and their dilution rate is not outpacing their progress. So I think that's a great thing. All right. So let's go to the balance sheet. All right. So notice from 2022 or even 2021, we see a decline in cash and cash equivalents due to cash burn. This is normal, which we'll look at the margins here shortly. And with that, the cash is going down, but let's look at the debt here. Debt is going up, all right? Ever so slightly, though, actually arguably flat here on the total debt, all right? But either way, I assess it's still going up a little, all right? So that's something to consider. With the combination of the cash going down, debt slightly going up, you're going to see the trend on your common equity to the shareholder go down, which, looking at this from 2022, shareholder equity to total common equity value has gone down. All right. Not really too much of an alarm. Now, when I look at this metric of total common equity, I don't really give it much stock unless it's some sort of manufacturing business model. All right. Whenever you got a business model where there's a bunch of people, or it's a company where there's a bunch of people in factories building stuff and it's high property, plant, and equipment on the balance sheet, I'm going to start judging total common equity more so than these other type of companies. There are material physical products with physical technology products that this company sells. All right. So that is a piece of the equation that I like to see when I'm looking at total common equity with the combination of actual physical tech products that are going to be adopted wide and mainstream. I'm going to go straight to their profitability metrics, which you see have staggering negative margins right here with a gross profit margin of 23.266%. If I'm looking at a sector where there's gross profit, um, if it's a sector with a wide total addressable market, such as vehicles, all right, and the disruption capability of the total addressable market is very wide to where they can impact and change the world with all these products, with wide scale manufacturing and so forth. Gross profit, it's okay for me to see low gross profit, as averse to a company in a sector where it's a niche product in a niche category with a niche audience. In order for me to see the balance of the double beam scale of my analysis, I got to see high gross profit margin, guys. All right. This is not the case. They have a wide total addressable market. Vehicles are all over the place, and autonomous driving will come in fleets. I assess it'll probably disrupt the taxi in Uber, although Uber is part of the disruption model to replace the driver and so forth. So I think that will give a good tailwind up front for these lidar companies. So as sales goes up and they scale sales, margins will become better and better, and gross profit margin will increase. All right. Looking at the investor presentation, I like the way the management has done this, guys. All right. They go straight to the point. They know exactly what investors look at, and they don't beat around the bush. They call it cash burn. They call cash burn, gross margins. They understand what metrics the investors are looking at. All right. And that's, I got to give kudos to the investment. So they're running a good company as far as making this investable for the market. All right. So with this, how do I assess this industry and this investment, guys? Well, um, I think that if they hit these growth metrics, this could be a good investment. That's if. Now, keep in mind, this is a foreign company. So inherently, versus an American company in a capitalistic structure, the foreign company is inherently going to be disadvantaged and have less access to capital markets, and the investors are not going to be able to participate in an uplisting of funds. Your S&P 600, your S&P 500, all right, and certain other investment funds of ETFs may consider passing on the company just because it's a foreign company. All in all, a dollar made is a dollar made, though, on the intrinsic value. Um, so with that, we talked about the margins. We talked about the balance sheet, which I anticipate they will need another capital raise because they're that far from profitability, and their cash burn, however, that it's getting better and better, that they're burning less cash, they're still going to need to raise capital and probably issue out more shares on a capital dilutive raise, which is fine because right now they're demonstrating the growth. So what's going to end up happening is they're probably going to have to close out Q4 with favorable growth metrics and continue to grow into next year. And when capital markets reward that, they're going to issue out shares and raise more capital. All right, because this company is trying to demonstrate to the market that they're worth the next round of investment. All right. Who do I think is the winner in this space? Well, I've done some research. I believe that a company called Ouster is the winner in the space. Keep in mind, going back to my original first part of the analysis, that I think that there will be maybe 1 to 3 winners. This isn't a winner take all market, but I think Ouster is going to be one of the bigger players that's going to be the big winner. Profitability metrics looked very similar to where Invz was when I was looking at Ouster just probably 8-9 months ago. I'd say I did if you go onto my channel and look for videos, I already did a review on Ouster for a stock analysis, so you can go back and check that out. If you're getting great value out of this, all right, hit the subscribe button, guys. check out my Patreon. All right. I got so much content on here. If you want the blueprints of value creation, what makes the stock go up, if you want to learn how to do price targeting, you want to benefit off a community of more sophisticated growth investors, you can see my latest and greatest research on there. Check that out. $10 a month, hit the free trial. I got several spreadsheets. You get more direct access to me, and ultimately you'll be helping out the little guy. All right. Channel is not big, but I do have a decent, good amount of investors in that community. All right. So that's good camaraderie and good development on our journey to grow capital. All right. So going back to it, Ouster, I think if you look at Ouster, here's a thing that I've noticed in my time investing in high growth stocks in these smaller cap companies. All right. The analyst consensus estimates, you see how Ouster's consensus estimates year over year are in that range of projected growth between that 30 to 40% year over year projections. All right. They have they have hit this mark or demonstrated that in their growth of sales within their business model. Their liquidity is more flush. They're an American company out of San Francisco. They also trade on the NASDAQ. So I believe Ouster, their investors will also be able to participate in uplisting opportunities and prestige of ownership. And I believe that Ouster is probably going to be the winner or one of the big winners in the field. Quick disclosure, I don't have a position in Ouster. I don't have a position in Invz, and for all intents and purposes, I don't have a position in this space. All right. So, yes, you may be paying a little more on a forward and trailing metric on sales with Ouster, and you may be able to get a better price coming in, but either way, I think Ouster is probably the better investment. That's just me. Comment down below on what you guys think. All right. What do you think of the video? What do you think of the channel? If hit the subscribe and like button, say I'm subscribed, I will respond back to you. I'll answer all the questions down there. I'm very interactive with the audience and so forth. With that being said, that's the stock analysis for Invz. I hope you guys enjoyed it. Thank you all for your support. I love y'all, and I'll see you till the next time.